Thank you for joining us today as we discuss what the economy and the markets did in 2022 and our outlook on 2023. I'm Arlene Dimitian, a certified financial planner here at Well Traveled Wealth, and I have here with me Todd Beckman, partner and certified financial planner at Well Traveled Wealth. As we were planning and preparing for our presentation today, we kind of jotted down a list of some of the most common questions and hot topics we've been getting from clients as we discuss what took place in 2022 and what we kind of envision going into 2023. So we're going to be taking some time to go through those questions. So let's go ahead and just jump into the first one. What did the Fed do with interest rates last year and why? Before we jump into that question, I think we need to discuss who the Fed is and what their purpose is. The Fed, in short, is short for the Federal Reserve and is our nation's central bank. It was created by Congress in 1913 to help promote a safe and sound monetary and financial system for our nation. The Fed has many important jobs, one of which and most recognizable function is conducting monetary policy. This involves influencing interest rates and the availability of money and credit in our economy, also known as the money supply. The Fed has been tasked by Congress to implement monetary policy to achieve two specific goals: to promote maximum employment and stable prices. High levels of employment provide people with more economic opportunities, and stable prices promote growth by making it easier for households and businesses to plan for the future. So let's go ahead and take a look at what took place last year and why.
Well, I think before we jump into that, it's great that we now know what the Fed, who the Fed is and what it is that they do. I think it's difficult to talk about what happened with interest rates in 2022 without going all the way back to 2008 and the financial crisis and what took place with interest rates back then. So if you all remember, which I'm sure you do, back in 2008 we had a housing crash, the stock market crashed, and we had unemployment rise to over 10%. And in order to spur economic growth, the Fed lowered interest rates. This made it cheaper for people and businesses to spend. Spending increases economic activity and creates jobs. However, over the next 11 years, unemployment slowly crept back down towards a more normal rate of around 3.5%. However, interest rates remained historically low. Fast forward to 2020, COVID hits. Unemployment jumps to over 14%, almost overnight. As we know, decreasing interest rates is one of the tools that the Fed uses to spur economic activity and growth. But since they really never raised them in any kind of meaningful way since the 2008 financial crisis, there wasn't really a lot of cutting that they could do. But they did cut the Fed funds rate to 0% in March of 2020. And again, the Fed funds rate is the rate that banks charge each other for overnight loans. This helps them stay within their reserve requirements. The Fed also flooded the banking sector with liquidity by purchasing treasuries and mortgage-backed securities in record numbers. And with the help of Congress, they rolled out various programs to help get money in the hands of individuals and businesses of different sizes. This massive increase in spending brought a jump in inflation, which the Fed initially dismissed as transitory. And we all know that it certainly was not transitory.
Far from it.
But if we think back to basic economics and supply and demand, what happened in 2020 is that all of a sudden houses and businesses were flushed with cash. So their demand for purchasing goods went through the roof. And we also know that in 2020, the supply chain was extremely disrupted. Being that we are a global economy, it was difficult for us to get shipments from some of these countries that were under various lockdowns. So what we have is really high demand and a really low supply, and just as it should, that's going to push prices up in the form of what we saw in 2022. Again, the Fed dismissing it as transitory certainly was not transitory, but they did start raising interest rates to try to slow spending and slow inflation. The target Fed funds rate went from 0% in March of 2020 to a current target of 4.5 to 4.75%, and that does take into account the quarter or 25 basis point increase that we just saw earlier today. These high interest rates trickle through to consumers in the form of the interest rates that you pay on a car loan, your mortgage, and even home equity lines of credit. In terms of the investment world, this makes it more expensive for businesses to borrow money, which slows their growth and their hiring. And in some cases leads to layoffs like you're likely seeing on the news pretty much daily right now. Now, the price of bonds have an inverse relationship with interest rates. So as interest rates increase, the value or the price of your bonds are going to decrease. And we saw that take place in 2022. We'll talk a little bit more about that in a few minutes, I think.
Most definitely. I think that's a perfect leeway into our next question. So what is inflation and how does this impact the market and the economy? I think it's important to start off with really what the definition of inflation is, and that's just the general rise in the average prices.
Right, just the idea basically of things getting more expensive over time. And as I talked about earlier, the Fed and Congress were really trying to do everything that they could think of to spur economic growth and avoid an economic collapse due to COVID. But I think it's pretty safe to say that they really didn't have a lot of foresight or a lot of thought about what those decisions and those policies would do to the economy a few years down the road. So in 2022, a lot of those decisions and policies were felt by consumers everywhere from the grocery store to the gas pump. One of the Fed's two mandates is price stability, being inflation. The Fed maintains a target of around 2%, and in 2022, the average annual inflation rate was 6.5%. This means that the price of goods and services was rising at a rate 4.5% above the Fed's target rate. From our earlier discussion on interest rates, we know that is one of the tools that the Fed uses to try to maintain price stability, meaning that in order to slow inflation, they need to slow economic growth and activity, and by making capital more expensive, consumers and businesses will be less likely to spend. So the idea is that as rates go up, we're able to bring prices back down.
Definitely. So this helps us get a good understanding of how monetary policy can be used to help manage, inflation. But how does that monetary policy also impact our investments? So we heard a lot in the news about the 60-40 portfolio, especially in 2022 when it was often discussed as the perfect storm for that portfolio. The 60-40 portfolio, it's a portfolio that consists of 60% in stocks and 40% in bonds, and it's a great way to hedge your investment against downward risk, while still providing yourself with a good amount of exposure to riskier assets in order to benefit from that long-term growth potential.
And I think that one of the reasons that strategy works is that typically stocks and bonds have opposite returns, right? When stocks are doing well, usually bonds are not doing very well. When stocks are not doing well, usually bonds provide a hedge against some of that downside risk Arlene just mentioned. But we know earlier that bond prices also have an inverse relationship to interest rates. And what happened in 2022, interest rates went up, meaning that the value or the price of your existing bonds went down. And this sort of created that perfect storm because typically stocks and bonds work opposite of each other. However, in 2022, it was one of the first times that stocks and bonds were actually falling together, both of them going down in the same direction. Interest rates went up, which hurt our bond prices. As interest rates went up, that slowed spending of businesses, slowed their profitability, which also hurt us on the stock side of things as well. So I think that's sort of what they're referring to as the perfect storm in that portfolio for 2022.
Yes, definitely. And a lot of times when we talk about stock performance, people refer to the S&P 500, which it's a market cap weighted index of the 500 leading publicly traded companies. And it's often used as an indicator of the overall direction and strength of the US economy. So how did the S&P 500 perform in 2022?
Well, not great. It actually ended 2022 down 19.44%. I think it's important to keep in mind that this is after a massive year that it had in 2021, where it was up over 26%. In fact, 2022, though, it was the worst year for the S&P 500 since the financial crisis in 2008. And not so fun fact, it was actually the fourth worst year of the S&P 500, dating all the way back to 1957 when that index was founded.
Yeah, we definitely had a challenging year with the S&P 500 last year. So I think that leads us into really, will the economy fall into a recession here in 2023?
We feel here that a recession does seem likely. Historically, inflation above 5% is usually a recipe for a recession. The Fed also making such large moves over a small period of time, because they were so behind the ball on inflation because they kept stating that they felt that it was transitory, which they clearly got wrong. Again, it's important to note that Fed actions typically have a lag between when they implement a decision and when we actually see that effect in the economy. And that lag can be anywhere between about 6 and 18 months. So I think that some of the economic consequences of their actions are yet to be seen. So I think we'll continue to see how those play out here in 2023. We do believe, however, that if there is a recession, that it will likely be relatively shallow and hopefully relatively short in duration, given the strength of the U.S. consumer, which does account for about 70% of the GDP in the United States. It's also important to keep in mind that equities typically do well in a post-recession era, especially value stocks, which we'll touch on again in a minute or two.
Definitely. Well, with everything that has gone on in 2022, what is the market outlook for 2023?
Well, we do see a lot of positives when looking at the market moving forward throughout 2023, and we're also hopeful that a lot of the pain of 2022 is behind us. Some of the positives: inflation peaked in June of 2022, so the Fed's actions of increasing rates seems to be working and bringing down the overall inflation rate. The labor market is extremely strong, with the lowest unemployment rate of the last 50 years of around 3.5%. A bright side in investments is that the income seems to be back in fixed income for the first time in a long time. So with increasing rates comes increasing yields in our bond positions. And also for the first time in quite a while, it's beginning to look like there's finally some appealing investment opportunities in the international space, especially looking at China with their COVID reopening, as well as some opportunities in Great Britain that we'll be keeping an eye on, just to name a few. However, I also think it's important to keep in mind, with the cost of capital likely remaining high for the foreseeable future, it's probably not likely that we're going to see the same level of returns that we've seen over the last decade, but that doesn't mean that there won't be room for positive growth.
Definitely see some opportunities there. So, given that 2022 was such a challenging year, what did Well-Traveled Wealth do to mitigate that risk or take advantage of some opportunities that were presented?
I think that's a great question. And actually, Arlene and I both sit on the investment committee here at Well-Traveled Wealth. And we meet quarterly to review our portfolios and all of the positions in our portfolios. We also submit our portfolios at least once a year to a CFA, or a certified financial analyst, that's independent of Well-Traveled Wealth. In fact, in 2022, we did it three times due to the extreme volatility that we were experiencing last year. And this serves as sort of the checks and balances to make sure that the thoughts that we have about the market and the economy are validated by an independent party, and really just helps us make sure that we're on the right track with our thinking. A few of the changes that we made to our portfolio throughout the year that we think are going to have some positive impacts moving forward for our clients is looking at a shift from growth to value. So I talked about how well the market did over the last decade. We see that shifting, and the economy sort of shifting into more of a slow growth stage, and part of that is due to the cost of capital being higher right now and likely staying higher for a while. Think back over the last 10 years with interest rates at near zero, it was extremely cheap for businesses to just invest money into their company, increase profitability, and increase sales by just flooding their businesses with cash. As that has now become more expensive, it is not likely that businesses are going to do that to the same degree that they did previously. So that's where that sort of shift from growth-oriented companies to value-oriented companies seems to be happening. So rather than being overweight growth stocks when compared to value in our portfolio, we actually became more equal weight between growth and value throughout the year, which again, we talked about in a post-recession. So if we do go into recession, as we come out of that, that should be a smart play for us as well. One of the other changes that we made to our portfolios throughout 2022 was to be able to introduce some commodities and some alternative investment strategies. We talked about how poorly the S&P 500 performed throughout 2022. However, that didn't mean that all sectors were doing bad. So commodities actually did pretty well for the first time in a while in 2022. Think about oil and gas companies, just as reflected at the gas pump. Record gas prices comes with record profitability for some of those oil companies. So by increasing our exposure to companies like that and other commodities, we were able to sort of hedge some of the other risk that was happening in the S&P 500 related companies and some of the fixed income investments. We also were able to increase our quality in our fixed income, which I think is really important, because previously, if we wanted to get yield or income out of our fixed income, we had to take on a little bit more risk because there really wasn't yield with interest rates so low. Now that interest rates have come back up, we're able to reduce some of that risk, because now we can invest in more quality fixed income or higher quality fixed income to get a sufficient amount of yield. And one of the last, I think, major things that we did for our portfolios throughout the year was take a look at what's called tax loss harvesting. And this is pertaining to our taxable portfolios. And the idea is that we're using a down year as an opportunity to bank some losses to hopefully help offset some capital gains in the future. So from a tax perspective, this can be a really powerful tool.
Yeah, definitely an opportunity we wanted to take advantage of.
Yeah.
So with all that being said, what's the plan moving forward?
Well, here at Well Traveled Wealth, we're always monitoring the economic environment as well as the market to make sure that our clients are positioned appropriately given what's going on at any particular point in time. But as always, we recommend that you review your financial plan at least annually with your financial advisor because it's always important to make sure that your plan is still on track to meet your goals and in line with your level of risk that you're comfortable with.
Thank you, Todd, for all this great information. It was definitely very beneficial, and I hope all of you found this information beneficial. If you have any follow-up questions, feel free to reach out to your financial advisor with those questions. We'd be more than happy to help. Thank you, and have a great rest of your day.